Okay, this is chapter 2, and I'm doing problem 2, 3, and it's algorithmic, so you're going to have something similar with just some different numbers. But I wanted to talk to you about the different accounts and sort of where they go. So each of these accounts are either going to go onto the balance sheet or the income statement, or in some cases, maybe a statement of owner's equity. So they're not going to go in both. It's either one or the other. And these are just in alphabetical order. No, it doesn't say whether they're going to be on the balance sheet or income statement. So we've got to kind of determine that. So what I want to do is go through each of these first and determine if it goes on the balance sheet or the income statement. So this accounts payable, that is going to go on the balance sheet. That is something that you will owe. All right. So just to kind of clear it up, maybe I should back up first. So what happens on the income statement is just income and expenses. So if you see any revenue or anything that says expenses, then you know that that is going to go in the income statement. If you see almost everything else, it's going to go in the balance sheet. So let's kind of take a look at these. So again, accounts payable is a liability. So it goes on the balance sheet. Assets and liabilities go on the balance sheet. And that is under liability. Accounts receivable, that is an asset. It's going to go on the balance sheet under assets. Accumulated depreciation. So you're going to see two different accounts. I don't see depreciation on here, but for depreciation, one is accumulated depreciation, and that is going to go on the balance sheet. And then you're going to have depreciation expense, and that is going to go on the income statement. Depreciation expense is your depreciation for just 1 year. Accumulated depreciation is what you've accumulated since you've had that asset. So these are going to go on the balance sheet. They're going to go under assets, but they actually reduce your assets. Automobiles, that is an asset. That's going to go on the balance sheet. Bonds payable is a liability. That's going to go on the balance sheet. Buildings, that's an asset. It's going to go on the balance sheet. So the way that I sort of determine what is an asset is if you have to liquidate, what could you turn into cash? And cash obviously is going to be an asset. So anything that you could turn into cash, you're going to consider an asset. Anything that says payable is going to be a liability. Capital stock, this is part of your equity. That's going to go on the balance sheet. Cash, easiest asset to figure out. That's going to go on the balance sheet. This income tax payable. So again, whenever you see a payable, you know that that's a liability, balance sheet. Interest payable, balance sheet. Inventory, that's the stuff that you're trying to sell. If you had to liquidate and turn that into cash, you could. So that's an asset. Land, that's an asset. You could sell it. Long-term investments is an asset. You could sell that for cash. Notes payable. So again, that has the word payable on it. That's going to be a liability, balance sheet. Office supplies. You could, if you had to, sell those and turn them into cash. So that's an asset. Paid in capital in excess of par. That is an equity item. That's just something you're going to have to learn. So it's going to go on the balance sheet. Patents, those are an asset. Prepaid rent is an asset. Retained earnings, that is the final number you get after you've closed out your balance sheet and income statement, after you've closed out your books for the year. So that's going to go on your balance sheet. And then salaries and wages payable, again, that has the word payable, so you know that's going to be a liability. So we have no income statement items in this case. So as we go through this balance sheet and what it means with classified balance sheet, so the difference between a regular balance sheet and a classified balance sheet is that the classified, same information, it's just broken down into smaller parts. So current assets, those are the assets where you typically are going to use that asset within a year. So let's see what our choices are. So that's a liability, definitely not a current asset. That's an asset, but we're going to use that for longer than a year. Cash, yeah, we're going to use that within a year. Let's see what our next one is. Building, again, it's an asset, but it's long term. We use buildings for longer than a year. Capital stock is an equity item. Payable, you see the word payable there, you know that's a liability, definitely not an asset. Inventory, hopefully you sell your inventory within a year. So we're going to consider that a current asset because you're really hoping to sell that stuff within a year, okay? All right. Automobiles, you use automobiles for longer than a year usually, so that's not a current asset, although it is a long-term asset. Capital stock is an equity item. You see the word payable there, you know that's a liability, not even an asset. Patent is an asset, but it's not a current asset. That's usually a longer term, and it's what's considered an intangible. So patents, you can't physically touch them, so they're considered an intangible. Prepaid rent, let's talk about that for a second. That is an asset. And what that means is that you've paid, let's say you've paid rent for the next 6 months. So you've prepaid that. You've paid that up front. And you usually don't prepay anything for longer than a year, so that's considered a current asset. Accumulated depreciation is not a current asset. That just lowers your long-term assets. Automobile is a long-term. Payable, liability. Land, long-term asset. Office supplies, you typically use your office supplies within a year. I won't put the numbers over here. But you would total those current assets and put them over here. Okay. So let's look at property, plant. We'll come back to this in a second. Let's look at property, plant, and equipment. So property, plant, and equipment are those items that are longer than a year. So liability, not even an asset. Short-term asset. Cash is short-term. Land is long-term. And we just said that the patent was an intangible. Automobiles is another one that you use for longer than a year. In this case, I'm going to lower my accumulated depreciation is going to lower my automobile. So every year you take depreciation and you lower that. Buildings, and then I have accumulated depreciation for my buildings. So if you come up here, you can see you have accumulated depreciation for automobiles. So I'm going to put my automobile, which in this case is $116,600. That number will never change. That is what I paid for my cars, and I will never change that number. But what I do is, as I take depreciation throughout the year, this number gets bigger, or throughout the years, I should say. So my net gets smaller, but this number never changes. This one, that lowers that, subtracts from it, will get bigger. Okay. And then my intangible is my patents. So I add all those up, and that gives me my property, plant, and equipment. The other one that I wanted, I guess, is fairly long-term is my long-term investments. Okay, so that doesn't fit into current, and it doesn't fit into property, plant, and equipment. It's more of a long-term. Okay, so let's talk about current liabilities. It's all those payables, and it's those payables that we're going to pay within a year. This is a little bit more straightforward. Accounts payable, we're always going to pay that within a year. Otherwise, it's called something else. Income taxes payable, chances are the IRS is going to want that money within a year. Interest payable, again, they're going to want that money within a year. Notes payable due June 30th, 2018. Well, let's see when this is. This is December 31st. So yeah, that's within a year. And then salary and wages payable. Chances are your folks are going to want to get paid within the next year. So those are all my current. Long-term is bonds payable due 2021. That's longer than a year. So it's still payable, but it's long-term because it's due later. Okay, now let's talk about our equity. So we have capital stock. That is considered equity. So when you first open a company, what happens is you sell stock and you get cash, and you use that cash for whatever you need, but you've sold a little part of your company. That gets stated on the balance sheet. The other one that we're going to talk about is paid in capital in excess of par. So what that is let's say that you have set a par value of your stock for $1 and you sell it for $1.50. That 50 cents per share goes into paid in capital in excess of par. And then you're going to have your total, which includes your retained earnings. Okay, so this is going to be your classified balance sheet. So I hope this helps. If you have any questions, let me know.